Hello everyone. In today's video, which in my opinion is one of the most important videos in this entire masterclass, we will be talking about risk management. I will explain risk management to you, what it is, how it works, and what the purpose behind it is. And as I said, please pay attention from the very beginning, take this video seriously because for me personally, this will probably be one of the most important videos in this entire masterclass. Risk management. Risk management means that you cannot treat every setup you see and execute the same way. You must not think in black and white. So, either I go in with the risk or not at all. You shouldn't have this kind of thinking because we are traders. We work with probabilities, and that's exactly how you should treat your setups. Is this setup now high probability or low probability? And based on that, you should determine your stake for this trade-off. Risk management is the reason for profitable trading. Anyone who can demonstrate good risk management can be profitable even with a low win rate. Because those who have good risk management have low losses and high profits. That is the purpose of risk management. That's why you should have risk management. Let me give you a practical example of how risk management can work. Here, for example, we have a 50K account, and with a 50K account, this is how I personally do it. I use $250 as a base value, as a guideline for a trade. If a trade now, let's say, as you can see, is in the middle, neither low nor high probability, let's call it a normal setup in quotation marks, then I would execute this setup with about $250. You can already see if we now have a high probability setup, then I'd be willing to put up almost double that amount and enter the trade with this sum. But likewise, with a low probability setup, I would use less than half that amount. So how do I assess whether the setup I have in front of me right now is high or low probability? I prepared a few example questions here. These aren't all the questions, okay? So don't let that throw you off. Every day, you should ask yourself different questions, or rather, different probabilities can arise each day. But here are a few example questions that can help you quickly decide whether your setup is currently higher or lower probability. Is the higher time frame institutional order flow clear? Are we in an uptrend, a downtrend, or a sideways trend? You need to define this beforehand. You need to be able to clearly identify this beforehand because we want to align the higher time frame with the lower time frame. And if the higher time frame institutional order flow isn't clear, well then the setup can't possibly be high probability because how am I supposed to link the lower time frame to the higher time frame if I don't even know what the current trend is on the higher time frame? In the same way, the higher time frame draw on liquidity must be clear. This goes in roughly the same direction. If I know where the market wants to go on the higher time frame, I'm able to link that with the lower time frame. If we have a draw on liquidity in the higher time frame that causes us to have a bullish trend, then I know what I want to expect and what I want to see in the lower time frame. Do we have any news? Let me say on a day like Monday, especially on a so-called no news Monday, the price action, based on my own experience and from the past, tends to be, let's say, a bit choppy. On such days, the market tends not to produce any real big moves. It tends to build up liquidity instead. In other words, on a no-news Monday, I would never execute a high probability setup with $500 or $400. Well, because then we're already back in the mid to lower segment. But if we've already had news, or if there is still news to come that, let's say, sets a clear direction, news that either manipulates or triggers a clear distribution, then that can make the whole thing high probability again. The same goes for the question, which brings me to the next point. What does the lower time frame price action look like? On the higher time frame, everything can line up and we can have a high probability setup, but if the lower time frame, let's say, doesn't do what we want to see, then there's no way I can go in with my maximum risk. Still, if the higher time frame is correct, because we know higher time frame, higher power, we're in a good position. If the higher time frame is correct, we're more likely to be at the upper end of the risk spectrum, but if the lower time frame price action isn't right, I still won't go in with maximum risk. And it's also important, how confident are you? That's a personal question. If you don't feel comfortable with a setup, or let's say something doesn't sit right with you, why should you execute? Why should you force your way in? That already moves into the emotional realm, where you're trading out of fear or greed. Another question I always ask myself before every trade is, if the trade I'm about to take, with the amount I want to risk, hits the stop loss, will I still be glad that I took this setup? Would I take it again, or would I be thinking at the stop loss, what did I just do? Like I said, that's a question that really goes into that emotional realm. Feel free to try applying that for yourselves as well. Personally, it really helped me to ask myself this question before every trade. Because if I go into a trade and I already know, wow, if this one hits the stop loss, then I really messed up, then I know I wouldn't take it again. So is that really a trade you want to take? Personally, I would say no. And that's how risk management works. You ask yourselves questions, you set conditions that define a high or low probability setup, and that way you can decide how you want to enter this trade. I hope the video was understandable so far. Risk management is incredibly important, and as I already said, you should be able to master the strategy well enough to evaluate setups. Anyone who has good risk management, as I mentioned at the beginning, already brings the fundamental building block for profitable trading. Because those with good risk management have low losses and, on average, high or higher profits. And that's the goal of every trader. You don't want to try to have more profits. You want to try to have fewer big stop losses, fewer small stop losses. You want to keep your stop losses as small as possible, in other words, keep your losses as small as possible, and then have a profit that is all the greater. And for that, even one trade a week is enough, just one take profit. In theory, you could be profitable with 4 stop losses a week and just one take profit. Because what do you think? Suppose you take 5 stop losses at $100 each, but then a high probability setup comes along that you execute with 500, with a risk-reward ratio of 1:4. Then you make $2,000 in profit, have lost $500, or rather $400, and you're still $1,600 in profit for the week. Just as an example. So it's not directly about the win rate, it's about risk management. Please take this video to heart, backtest risk management if necessary, and apply the logic I just explained to you in the live market. Use it for yourself. I can only recommend it to you. Risk management, as I said, is for me one of the most important factors for trading profitably. I hope, as I said, the video was understandable. If you have any further questions about risk management, as always, post them in the questions channel and tag one of the founders, and you'll get an answer as soon as possible. I'd say, see you in the next video. Bye.